this alternative investment webinar series where we talk about specifically today real estate investment trusts, what they are, where they are today, the outlook, the role that they can play in portfolio management. And what we'll do here in the beginning is just talk a little bit about, again, the investment philosophy as far as why we Biltmore includes alternative investments and why we think that's so important. And then we'll get into why specifically REITs. And then we'll ask some questions as we go. And as always, we know everybody can be busy except for all you retirees out there. And it looks like there are a bunch on here. But for all of you that are working or have some things that are going on, we'll get through this in a timely fashion. So just want to talk a little bit about our philosophy because, again, I think that's very important as it plays into why REITs. A lot of investment managers out there, when you walk into a financial planning shop or an asset management shop and you talk about asset allocation, generally they talk about stocks as being the growth engine in the portfolio. Well, you need some kind of stock over time because that's just how it's been done for so long. And I think it's interesting always to look at this chart. It's a chart of the stock market going back pre-1900. A lot of the large Wall Street firms will just show you a chart post-World War II, and it shows a really different story than if you look back pre-1900. When you look at this, it shows you these long periods of time where the markets just haven't performed. Here before 1910, up till the early 20s, there was about 18 years where the market literally just went up and down and up and down. If you were that lucky investor that invested in 1929, it took about 25 years to get back to even. More recently, in the late 60s to the early 80s, you had about 17 years of flat performance. And so far, since 2000, the market is actually down since the peak in March of 2000. So we've had about 11 years of sideways performance. And I guess the question begs, with such a low interest rate environment, is it time to really be holding tons of bonds when bonds typically will move down in price when interest rates go up? The answer is probably not. Bonds certainly serve a purpose, and there's certainly a reason to have some bonds in there. And stocks, are we in such a great environment? We've had to have QE1 and QE2 to kind of help get us out of this, and there's lots of talk about QE3. While markets have certainly been doing better the last few years, do we want to be all in the stock market, or have a lot in there? So again, certainly serves a purpose, but probably there's room for other types of investments within the portfolio. So what we did was we took a look at many different large institutions, Yale, Harvard, Princeton, and how they invest. And the big difference was that institutional portfolios, and these are generally very successful pools of capital, they typically have very high allocations to alternative strategies and alternative assets. And we're going to be talking about one of them today, REITs. Whereas traditional portfolios, mostly a lot of the people that might be listening in, retail investors and a lot of high net worth investors, they typically just look at stocks and bonds. And there might be different types of stocks, like international, but typically traditional portfolios have been made up of stock, bond, and cash, whereas alternative institutional portfolios have been much more diversified into different alternative strategies and alternative asset classes. And this just further demonstrates that, again, traditional investments being different kinds of stock, big ones, small ones, growth stocks, value stocks, different kinds of bonds. Whereas Biltmore Capital in our asset allocation and our investment thesis, we're investing the way that a lot of these college endowments do. We don't want to be reliant solely on the stock market, solely on the bond market. We want to look at things like REITs. We'll talk a little bit more about that today. Last webinar in January, we talked about master limited partnerships, which is one of the ways to access energy through pipelines. And again, there's a great case for why that continues to make sense as a growth play, but also an income play with all the infrastructure that needs to be built for these pipelines because of all the new finds in the energy space. Commodities is one that we'll get to soon enough. And as we continue to go forward, we're going to talk about alternative strategies such as long-short, global macro, and managed futures, which will be webinars in the future. So again, today we're talking about real estate. I really like this chart because most people that are out there lost a lot of money in 2000 or 2002, one of the last times the market came apart. And as you can see, if you follow my pointer, REITs are sort of the pumpkin green or the fluorescent. I'm sorry, orange. I think I'm colorblind here. The orange is REITs. So in 2000, when the market was down dramatically, REITs were up almost 30%. In 2001, REITs were up almost 14% when the market was down further. In 2002, when the market was down about 22%, REITs were up 3.5%. So again, this sort of blends into our philosophy. We want to have assets and investments that perform well over time, but we think it's very important to have assets that perform well at different times. Obviously, REITs did very well in 2000 to 2007, up 36, up 32, up 12, up 35, up 15. They hit it pretty hard. I'm sorry that this is a little bit unclear, but they were down about 37% in 2008. Then they've swung back nicely over the last couple of years and have been some of the best performers again. And again, this is measuring the REIT index. So we're just looking at the REIT index, not any kind of actively managed strategy. So again, the REIT index is made up of several of the largest real estate investment companies. And again, we'll talk a little bit more about that. But again, we think it's important to have a mix of all these different types of styles and strategies. Things like in 2008 that were up. Managed futures were up 14%. Most other things were down. 2008 was a tough year. So there weren't too many things that did very well, but there are things that help protect downside. So let's get into and talk a little bit about REITs. And we might start a little bit rudimentary for some of you. We're just going to talk a little bit about what they are and what they do. And then we'll talk a little bit about what's going on in the REIT world and the environment and with dividends, et cetera. So REITs are companies that own commercial real estate properties. So when assuming you don't live in Manhattan, when you get in your car and you drive from work or from home and you're going to work, you probably potentially pass shopping malls that you go by or public storage centers, or maybe even the office that you're working on is owned by a REIT. These are all investments that REITs make, and they derive their income through the rental income that the tenants pay. So a couple things about REITs is that and these are REITs that trade on in the market. They're companies that own real estate properties. They typically they have to distribute 90% of their income to shareholders, which typically increases their dividend more than, say, a stock would. Current dividends in today's environment are paying about 3.5% to 4%. So they were certainly paying a lot more, a year ago, a couple of years ago, because the prices of these companies were so cheap. And we're going to talk a little bit about yield and what we expect, because we do think that will be going up in the future. They typically own, as we talked about, malls, shopping centers, hospitals, office buildings. And one really interesting thing, we hear this a lot about clients now is, what are we doing? Inflation will come at some point. Interest rates will start going up. What do we do with large bond portfolios? How do we hedge against inflation? And REITs are generally, a great hedge against inflation, because if you think about the lease that's made between a property owner and a tenant, if that's coming up every 1 to 3 years, if prices are higher, guess what? That cost of renting that space continues to climb. So again, it's a great hedge against inflation. What you'll see is a lot of REIT companies now are shortening their leases. They don't want to be locked into very low lease rates in an environment where we might have inflation. So we were fortunate here in our building to lock in for 3 years. That's typically the most that you'll see. And typically, what you're seeing now is that things are very short-term. It's hard to lock into long-term leases because companies want to have the ability to increase rents every year or every 3 years, which makes sense. Let's talk a little bit about the REIT outlook for a minute. U.S. economy is improving, as we have, at least from the data that we see. We're seeing unemployment come down. In general, things seem to be getting better. What that's doing, occupancies are rising, and we'll talk about this a little later. But as companies hire more people, they typically need more space. As businesses are growing, they need more space, et cetera, et cetera. We're seeing rental rates starting to increase. A lot of investors out there are purchasing REITs for their sort of strong and predictable cash flows. So that's, in an interest rate environment over the last few years where the 10-year Treasury bond was paying 2% or less, a lot of people that sort of bought into REITs as a bond alternative. Certainly, there's a lot more risk to a REIT than a bond would be, but people that are putting new money to work or whose bonds are maturing, they've been looking for new places, so they've found that in REITs. We're early in the real estate cycle, so at this point, what you're seeing is that there's a lot of demand for core properties. Companies like, for example, where Chicago Options Exchange is, they lease that building from a REIT, and they're probably going to continue to pay their bill. I mean, if the Chicago Options Exchange melted, that would be a huge problem. So there's a demand for a lot of these core properties. There's not a whole lot of speculative properties or really any development that's occurring at this point. We're going to talk about that a little later. We expect there to be a large divergence in the market. And just a couple examples of that. First of all, San Francisco market is doing phenomenal. It's fueled by the tech boom. Facebook and Google and all these startup tech companies. They not only need places to do their business, but the people that are working there want apartment buildings. So areas like San Francisco are doing phenomenal. It's one of the hottest areas of the real estate market, again, the REIT market. And that diverts from areas like Nevada. Nevada's REIT market was really built because of the housing boom that was going on. And as we know, the construction and everything has basically come to a halt. People have moved away to find other work. And that's a problem. I mean, even the casinos are having issues. A lot of the malls out there are having a lot of problems and shutting down because, again, they were there because of all the people that were rushing to the housing boom and the casino business, et cetera. So I'm just trying to make the example. You're seeing, again, a big difference in sort of divergence between where you are and the types of REIT sectors that are out there. An interesting fact, kind of factoid here, 90% of the REIT market is privately held. So the REITs that we're going to be talking about are publicly traded REITs. Over the last several years, REITs in general have been on the defensive. again, a lot of the typically their mortgages come up every 6 years or so, and it's been very hard to refinance, in that environment, as many of you may realize. When you have a property that's gone down a lot in value and there's not a whole lot of equity in it, that's an issue. So REITs have been spending a lot of time sort of cutting. Again, this is looking backwards. They spent a lot of time cutting their dividends, actually, so they could pay down their balance sheets, pay down their debt, so they could have some equity, a lot more equity in these buildings, so they could refinance them at a lot better terms. So they've really spent the last several years being very defensive in nature. They've started to go on the offensive now. You're starting to see, acquisitions being made. They're able to raise money. Some are going public. We just had a REIT go public here a couple of weeks ago, and they're doing that so they can raise money and create more value for shareholders. So, again, times have sort of changed, for the REIT market. We'll talk a little bit about sort of how some of our managers are positioned, just to give you a feel for what's going on in the space. And one of the things that I'll actually that I'll start with here, again, office REITs are doing very well. Again, as unemployment rate is coming down, we're seeing a lot more vacancies going down in the office area. Regional malls, especially high-end regional malls, the upper echelon continues to buy. Here the Short Hills Malls, for example, again, is a mall here in northern Jersey. They have a valet out front, for the people that come to the mall. So it gives you, a feel for the kind of people that they're getting. They have Saks in there, a lot of high-end, retailers. Some of these regional malls are doing very well. The regional malls are typically enclosed type of malls. On the other side of that, outlet centers are considered regional malls. They're also doing well because it's sort of on the other side of that. People they want to get a good deal still out there, and they're going to a lot of the outlets. So again, these regional malls are typically doing better. Self-storage also doing a lot better. We're seeing people that can't afford to be in their homes. They might be going to apartments. They're downsizing. Storage centers are continue to grow. Things that aren't really one of our managers that manages these portfolios, they're underweight things like shopping centers. What we've seen is and when I'm talking about shopping centers, these are typically the strip malls that you might see. They might have one tenant anchor with a lot of other smaller, drug stores, maybe a massage parlor, pizza place. They're not doing as well. There's typically still a lot of vacancies there. You had a big issue a couple years ago. Circuit City went bankrupt, really hurt this area. Sears stores are now closing. So there's still, again, some risk there in the space. Healthcare, these are things like surgical centers, hospitals, again, with a lot of regulations kind of coming down in that area. So, again, an area that's underweight. Freestanding net leases. These are, your CVS that might be on the corner, or, again, a single standing store. There's just a lot more risk to sort of one freestanding lease. There's for a lot of these companies, there's too much work involved with just having one tenant. So again, this area is sort of underweighted. A lot of these type of freestanding areas, the leases get complicated because the tenant is responsible for doing some of the improvements, et cetera, et cetera. Again, it just makes it a little bit more complicated. One of the areas that's actually not on this list that I wanted to mention was multifamily. These are apartments. These are clicking on all cylinders. We have a situation here, in the U.S. where there's really an inability to purchase homes, and some of you might have experienced this. We have clients with, millions of dollars in some cases where they can't get a mortgage. Credit has gotten harder to find. with high unemployment rates, it's created an opportunity for multifamily housing and apartments. So there's an interesting statistic. People that are 35 and under, 95% of all those people are renters. So again, if you're 35 and under, 95% chance that you're renting now. And for every time home ownership declines by 1%, an interesting statistic, you have 1 million new renters on the market. So to kind of talk about this in historical terms, at the peak, when it was easy to get a mortgage, when unemployment was low, there was about 70% home ownership here in the U.S. So 70% of everybody we know owned a home. At this point, we're at about 66%, and we expect that to fall further. So this area, being a multifamily housing and apartments, it's about 95% occupied, and that's what you want, right? When you have an apartment building, you don't want any empty space. That means you're not bringing in any rental income. So this is a real hot area of the market, an area that continues to be really solid, in an area that's overweighted, again, with some of the portfolios that our managers are managing for us. So again, we want to talk about, we're going to talk about income in a minute, but what's making this sort of more attractive? U.S. construction is at a multi-generational low. For those of you who are retired in Florida or have a house down there, and even on parts of the West Coast in California, you remember it wasn't too long ago, 4 or 5 years ago, where you looked on the skyline and there was cranes, in Miami, South Florida, parts of California, building, office buildings, building apartment buildings, strip malls, etc. And you go down there now, and I go to Naples several times. We have a lot of clients down there, down in Florida, and literally you go by and there's weeds growing. There's a building that's halfway done, and there's weeds that are 5 feet tall because there's just no demand. So that's what we've seen. Really, most parts of the country is that nobody's really building these anymore, and the capacity is being absorbed into current buildings. So, we're going to talk about this as far as why we expect dividends to continue to increase, but you'd expect over time the first thing that's going to happen is that capacity is going to be absorbed. So again, there's a lot of vacancy. There's still a lot of vacancy out there in a lot of these commercial buildings. As the economy improves, as things get better, there's no need to build anything at this point because there is space that's out there. So we expect that to continue as we get forward into 2013 and even 2015. We think that the building is still going to be a lot less than it was in 2007, just because we don't need it at this point. We way overbuilt, and we need to have some capacity absorption first, which is very good for the current REITs that are out there, because that just means they're already paying for the space. So the more tenants they get, that hits the bottom line pretty quickly. Even one thing I want to talk about, one of the questions that was asked during a review yesterday was, the unemployment. You're seeing unemployment come down slightly. We had 100,000 jobs that were added, plus or minus a few thousand last month. What does that mean? Well, even if we get 100,000 jobs that are added, it's turning, the dial towards the REIT's favor. So it's better. It's certainly getting better than nothing. The fact that there's no more supply, really not a whole lot of supply that's being built, even if we're getting 100,000 or 200,000 new jobs a month, that's still a benefit to REITs. So talk a little bit about the cash flow, because some of you that are listening in are retirees, and some of you are sitting on bonds and are worried about interest rates going up. And that's one of the things as an investment committee here at Biltmore Capital that we've been trying to solve for is how do we solve for bond income? How do we take the risk of declines in bond prices out of the portfolio, or at least limit that risk and continue to get the same income that we've been doing, or that we've been getting prior. So again, we'll talk a little bit about that. So this looks back to 92, and it shows us that the average dividend growth rate, I guess from 93 to 2007, was about 5.9%. And one of the reasons for that is that I mean, money was also easier to come by. You could buy a building, put 20% down, borrow money at 4 or 5%, and get tenants in there that are paying 10%. So the difference between your cost of these REITs' cost of borrowing and what they were bringing in was quite dramatic, and that actually led to a lot of companies out there that many of them aren't here anymore, but it led to a lot of speculation and over leverage in sort of the 2005 to 2007 period. And when the you-know-what hit the fan and everything melted down, dividends declined pretty dramatically. And so again, by about 26% annually, over that period of time. And a lot of that was because they were forced to pay down debt. I mean, a lot of these companies barely got out of this alive, and some of them, I mean, most of them are probably going to be okay at this point. They're still going to survive. But as I said, I mean, some of these companies were going to the banks. They had 10% equities, or they had negative equity. And so they had to cut the dividends to pay down debt, so they were able to refinance these buildings at some kind of a decent rate. So that's kind of looking back in the rearview mirror. Going forward, and we'll talk about what's happened in 2011, but we expect that the dividends will start growing pretty healthy, and that's really for some of the reasons that we've already talked about: an improving REIT market, improving numbers as far as tenants. Job market seems to be getting better, more space being demanded, et cetera. And this sort of drives this home. Last year in 2011, this is an interesting statistic because I think it just shows you how things are getting better. In 2011, there were 57 U.S. REIT companies that declared dividend increases for the whole year. Again, 57 for the whole year. So far, in the first quarter here in the U.S., we've already had 30. So we're more than halfway where we were last year. And I think this is just showing, sending the message that, REITs have stronger balance sheets. As I said before, they're going on the offensive. They don't really have to pay down the debt that they were paying down before. Again, these are companies like Simon Properties. Again, they're one of the largest REITs that are out there. Mack-Cali, if you're actually here on the East Coast in Jersey, Mack-Cali's the huge REIT, owns a lot of office buildings in and around the Jersey area. And again, we can see a lot of that's coming from multifamily. I made that case for multifamily. Again, these are the apartments. They have some of the best occupancy rates. They're doing very well. Anyway, things are getting a little bit better out there. And the last thing that I'll mention, and again, we'll sort of break for questions right after this. Last thing that I'll mention here is just talking a little bit about the earnings of these REIT companies. And if you think about the earnings, and I'm blocking out of 2008, 2009 when your tenant just can't pay or they're going bankrupt. Obviously, that's a big risk in REITs. Is if we do get another double dip, that would not be good for the REIT market. At Biltmore Capital, we're assuming that things are getting better. We don't think it's getting better all that fast. We're sort of muddling along. We're adding, as we said, 100,000 new jobs, 200,000 new jobs. So We don't think that we're going to enter into any kind of cataclysmic 2008 anytime soon. Could it happen? Yes, which is why we have other investments in portfolios that can hedge downside or even do really well if the market tanks. But as far as REIT earnings, typically there are long-term leases or at least year-long leases that are locked in. So cash flows tend to be a lot more predictable. They can look at all their leases, and even if you're an analyst looking to buy REITs, you look at Simon Properties, you look at all the real estate that they own, they look at the rental income that's expected, and those are locked in with leases. So there's really not tons of fluctuation. And that's really measured by the REIT, the blue line. You can see that it's fairly steady. If you're a company like Apple, and granted Apple's been a great company to be in, if you're a company like Apple, from quarter to quarter you're trying to figure out how many iPads are going to be purchased, how many iPhones are going to be purchased, what are my expenses going to be. And it's a lot harder, although Apple might not be the greatest example because that just continues to climb. But for a lot of companies out there, from quarter to quarter, things change a lot more. So you typically get an earnings profile of companies in the S&P 500 that are, that can change and can be very volatile. But when you have, again, leases and that are locked in for 1 to 3 years, with the earnings of these REIT companies, they typically, are a lot less volatile than the S&P 500. So as an investor, as you see, potentially the value of the company go up and down, I think it should give some type of vote of confidence, or at least some assurance that you know what you own. You own these companies, you own this real estate. You own Simon Properties because they own good quality real estate. It's a great management firm, and they have great leases that are locked in, and those earnings shouldn't change a whole lot from quarter to quarter. So again, in sum, we continue to think that REITs are a great place to be over the last quarter. For a lot of our diversified portfolios, they've given a very strong performance in the first quarter. Along with a strong cash flow. We continue to think that they have jumped up in price over the last few years, just like the whole rest of the stock market has. But again, with the improving fundamentals of the overall economy, we continue to think that having an allocation to REITs make a lot of sense, especially to income investors that are in need of some kind of income. So with that, again, hopefully this works right. We can you can put a question into the webinar, or you can put a question into the webinar, or you can raise your hand on the webinar, and we'll unmute you and have you ask the question. So again, I'll open it up to questions. Okay, well, I hope that we had an issue last time where people actually did have questions, but we didn't see them. But as always, if anybody has any issues, they can email me directly at tvernon@biltmorecap.com. That'll go to me directly, and I'll try to answer the question directly. It looks like we don't have any specific questions, so with the amount of people that are on the webinar, that's surprising, but I'm glad we answered the questions. And again, feel free to contact me directly or any member here at Biltmore Capital, and we'll try to do the best we can to take care of you. Hope you found today's webinar